And so moving on, and I'll leave it on that just for the moment because I want to talk about this slide once more. But if you've got slide after all the various steps where it talks about it is possible and acceptable to combine the entries. It is possible to do that. So that is actually combining the entries. You could have them equally split out. What is also important is that you could offset the effects. That hasn't been offset yet. So that's one way of doing it. I'll show you what would happen if we offset it. So you can offset DTAs and DTLs in certain circumstances. So we've talked about offsetting before. We talked about financial liabilities and financial assets. So if you think about a forward contract which you've set up as a hedge, we're seeing that kind of payable sit up, we're seeing that receivable, and we actually net them out because we have the same counterparty. When we have leases, we don't set off. We show the financial leased asset, and we show the lease liability, and we show them as an asset and a liability. With tax assets, in certain circumstances, you could do something like this. Debit DTA, 9,000, credit income tax expense, 9,000. So you could have what's up here, or you could just net those two out and have DTA 9,000, credit income tax expense 9,000. So the tax expense impact is still the same. We're just not showing the two amounts at their gross figures, we're just netting them off. And you can do that if the tax jurisdiction you're working in is the same. So if this is purely in Australia, purely dealing with the ATO, then that is not a problem to do that, and we're quite happy for you guys to do that in an exam. So you could do it that way, you could do it that way, as long as you end up with, I suppose, the income tax expense of 9,000, which means the total tax expense in this situation is a strange drawing and looking somewhere completely different. Okay, so 130,500. So that is what your tax expense will be picked up as. So you look at the profit and loss statement, that's what you see, even though that is not actually what you paid to the government or owe to the government. Now, a couple of miscellaneous things to deal with before we sign off. First is how to deal with tax rate changes, second is how to deal with tax losses, and the third is how to deal with revaluations. When the tax rate changes, and there is calls for changing the tax rate to 28.5%, which is a really fiddly number, but could happen. When the tax rate changes, that is going to affect the DTAs and DTLs that you have to start with, because those DTAs and DTLs were created based on a certain tax rate. So that $50,000 provision for long service leave we talked about earlier, that gives rise to a $15,000 DTA based on a 30% tax rate. Because the benefit you get from that future payment is going to reduce the amount of tax that you pay. But if the tax rate changes, the benefit that you get from that will change. So if we've got a $15,000 DTA, that's been caused by a temporary difference of 50,000, so at 30%. If that changes, and the tax rate goes down to, for example, 28.5%, we still have this temporary difference of $50,000, but the amount of the DTA has reduced to $14,250. So we've now got a lower benefit because the deduction we get is actually lowered. If you take that down to extremes, imagine if that went to 0% and companies didn't have to pay tax at all. They get no benefit from having deductions because there's nothing, they're not paying tax anyway. So the deductions don't actually matter. So the DTA in that case would be worthless. So you actually need to pick up the fact that that DTA opening balance is going to be affected. So that would be, if you see the tax rates changing, that's the first thing that you do, affect the balances and then work out the rest of the effects. Tax losses. Now, from the slide, if you got it in front of you, rather than me flicking back because I need to do some drawing with this, tax losses are created when allowable deductions exceed assessable income. When they occur in Australia, you can carry them forward. So let's look at a situation where a company makes a profit or an assessable, taxable profit of $1,000. So this is all tax. So if you make a tax profit, assessable income of $1,000, and the tax rate, let's just keep working on the 30% tax rate, how much tax are they going to pay?
300.
Yeah, they're going to pay $300. So what you're going to see is debit income tax expense. Whenever I see income tax expense, I always think they're paying a lot for computers. But credit, let's just assume they're paying it out in cash. We see $300 go out. If they make a tax loss of $1,000, let's just call it an income tax expense. It'd probably be picked up as an income tax benefit of $300. Is the government going to give you cash in that case? No, they're not going to actually give you $300 in cash. And I know the entries are on the next slide, but you'll have debit DTA 300. So rather than getting cash, you're just getting a deferred tax asset sitting there. So if that's time one, if we go to time two, they make a taxable profit of $3,000. So in that case, they make a taxable profit of $3,000. What you would usually see in that case would be income tax expense of $900, and you see credit cash of $900. So that's what you'd normally see. But because you've got this carried forward tax loss, you're not actually going to be paying out the full 900 because you've got this DTA which you carried forward and can use against your future taxable profits. So that will ultimately reduce the amount of tax that you're paying at that point. And when you kind of look at the overall effect, the 2-year taxable profit has been $2,000. And in sum, we have debited income tax expense $600, and we have credited cash $600. And that's what you'd like to see happen. We've had $2,000 of profits over those 2 years. We've recognized $600 of tax expense, and we've had $600 of cash being paid in relation to that. What hasn't happened is we haven't got money coming in and then money going out. So we haven't 300 in and then 900 out. We've just had nothing come in and then only 600 out. So that's what's being picked up with a carried forward tax loss. And again, to be able to carry that forward, you have to expect that you're actually going to have profits you can offset it against. Because if this situation never happens, you're never going to actually be able to use that DTA. So that's what we're talking about, the write-off of DTAs. And the last one is an asset revaluation. So if we have an asset revaluation, we debit the asset credit revaluation surplus. So that's what we've looked at before. But what's getting picked up there is we haven't adjusted, we're not going to be adjusting the asset for tax point of view. The tax, that's an accounting effect. Asset revaluations are an accounting thing. So it's not you're going to be changing the tax base there. So it's having an effect on, if you come to sell that asset, I think, do we have numbers on the next one? We do. So with this asset here, this is what had happened. If you're doing ABC, you've seen examples like this. Not ad nauseum, but you've seen a few of them. So the asset goes up by 20. You're picking up the revaluation surplus as only 14, and the deferred tax liability is being increased by the tax rate of the revaluation. So it's going up by, in this case, $6,000. Now that tax liability is basically saying you're going to be paying more tax some point in the future. So like a DTA is picking up, they're going to be paying less tax sometime in the future. A DTL is kind of picking up that you're going to be paying more tax in the future. Think about what that represents. It doesn't mean, you don't necessarily have to sell the asset, but imagine what this is picking up. If the asset has gone from 100 to 120, that's saying that is the market value. That is the fair value of the asset because that is what you've revalued it to. So if you revalued it to 120, for tax purposes, it's still worth $100,000. If you sell it, you've made a gain of $20,000 and you're going to be taxed $20,000 on it. So that's kind of picking up this, it's almost like this unrealized profit on it, and the fact that you've kind of got this $6,000 you're going to pay at some point in time. And that's why you've got this deferred tax liability. It's kind of representing that you are in a situation now where you know you're going to be paying more tax because of it. And that's, again, it needs a little bit of time to percolate, but that's the general idea with it. Now, is there an asset in general? So DTAs and DTLs. A lot of analysts actually strip out these numbers when they're analyzing a company because it doesn't necessarily mean anything. When you have an asset, it's not that the government owes you money. Like you can't go off and knock on their door and say, hey, like, I've got these huge amount of DTAs, I'm a bit skint, can you pay me some of that? You don't actually have an asset in sort of the way that we normally think of an asset. In a way, it's dependent on something else. Like to get a DTA, to be able to use it, you've got to be able to generate future taxable income. So in a way, it's almost a contingent if you think about it, because to get the benefit from it, something else has to happen. But this is one of those things. Not everything in the standards is necessarily wholly consistent with the framework. Is there a liability? You don't have a present obligation for it. It's not like you owe the government any money. It's looking at what's happened. If something happens in the future, then we will have that money owed. Now, I do want to actually do something like Excel just to pick up some of these issues. Also assumes there's no change in tax rate, and that actually holds a little bit for DTAs. Now, because we didn't really show it, because we were going to show 20 years of data, and that was just too much to do. But this is actually somewhat important to do. So time, I won't do it for the full 20 years, but let's minus so it's not the same numbers as before, but it's okay. So imagine we've got a $200,000 asset that we've purchased. Its carrying value is $200,000. It gets depreciated out evenly over 10 years. We end up with a zero at the end, $200,000, and it's reducing by 20. The tax base is being done at over 5 years, so obviously you wouldn't see this happen. Once you're down to zero, you're down to zero. And so you've gone $200,000, you've started at the same point and you've ended at the same point. Because when we calculate out the temporary difference, we start at a zero temporary difference and we end up with zero temporary difference. The difference is temporary. That's an important aspect to it. Multiply that by the tax rate. And what you see happen is, and I just want to show you one more thing on top of this. You'll see that the tax rate, the temporary difference, or the in this case, the DTL climbs up to 30,000, then drops away. Now, most companies, with property, plant, and equipment, won't just buy property, plant, and equipment in 1 year and then leave it at that. They'll have, a capital works program. They'll be, investing in things over time. So you could likely see this happen each year for some time. Or let's just do it. They purchase a $200,000 asset every second year. And so you'll see this start to repeat. Let's just do it for a couple of years. Okay, that should be enough. So the net of all of these funny little bit in the middle. But the net of all that is, as long as you keep, we only purchase for the first few years, that temporary difference, or that deferred tax liability just keeps growing. And as long as the company keeps investing in property, plant, and equipment, that deferred tax liability never actually washes away. I mean, the individual ones do wash away, but it actually just keeps building. Qantas have something like $700 million of deferred tax liabilities on their books. That's because Qantas have this huge amount of property, plant, and equipment there, and there's depreciation differences between that property, plant, and equipment for accounting and for tax. Does it really tell you anything about the business? Will those things just keep growing up? Quite possibly. So it's just something to be wary of. Not wary of, just be aware of. So to finish up, we looked at the tax payable, tax effect methods, the balance sheet approach, calculation of all the things that we need to calculate, and looked at a few other bits and pieces. Cash flows next week. That's the last content. The week after that is revision, as well as handing in your bonus assignment if you have registered for it. Enjoy the week, the rest of it that exists. Have a good weekend, and I'll see you guys next Thursday.